Hi, everyone. Welcome to the 200th episode of the Crowd Forecast News show from TimingResearch.com. Today is October 22nd, 2018, and we are broadcasting live on YouTube at 1 p.m. Eastern Time. But I am also posting the audio-only version of all episodes as podcasts on iTunes, Spotify, Stitcher, Podbean, and wherever else people listen to podcasts. If you're watching the video, you should see the PDF version of today's report on your screen while I'm talking. You can also go to TimingResearch.com/reports to download this or any of the past reports there. I have Dave Landry back to moderate today, and I think he just logged in. Dave, are you there?
Yeah, I am. I just they were running a little late over there as usual, so
Okay.
I literally just got off the phone. So I see my camera's not working, but I don't know if you want to look at me anyway.
All right, we're just getting started here, so you want to go ahead and take over?
Okay, cool. All right, Neil, let's go to you first. You know the routine. Neil's a veteran of the show. He's been around for a while. So for those of us who don't know you, tell us a little bit about yourself and a little bit about TraderReview.com.
Well, Dave, why don't you just tell them, because you already know.
Neil is an awesome dude. He travels the world, and you don't want him to put his camera on either, because sometimes it's hot where he is. He trades without a shirt on. So I think that's about all you need to know about Neil.
Well,
now,
okay.
I dig what you do, man. I like your I like the stuff you do with point and figure and those other indicators you use. So go ahead and take it away.
So I used to be a broker at a big firm way back now in 98, 99, right out of college. I loved the free lunches that the mutual funds would come and give us when they'd give their presentations so that we could pitch their funds. And I realized it was a sales job, not really an analytical job. And I didn't want to call people constantly trying to convince them why they should buy Sun Microsystems. So after that, I did some business consulting for a while, and then literally was skiing one day, and I thought to myself, wait a second. I went to a point and figure seminar when I was a broker, where I would bring some people, and some guys from our other office gave a presentation of point and figure. And I'm right out of college thinking that you can't time the market. They teach you all this nonsense, capital asset pricing model. You can't time the market, et cetera, et cetera. The market knows everything literally at every microsecond and is perfectly priced. And I see this point and figure seminar, and I thought to myself, oh my God, everything I was taught in college is wrong. You can time the market, you can time the sectors. And then I started out my own service using point and figure. And in the last few years, I've added the Ichimoku Cloud as well for more fine-tuned timing. And we do stocks, options, ETFs. And I also look at futures as well. So
cool.
That's what I do.
Well, I have to say, I often quote you when trying to explain to other people, brokers sometimes. Not that all brokers are bad, but I love the phrase you use, asset gatherer. So I think that's pretty cool.
Yeah, that's what they told us in the training. You're here to gather assets.
Okay, Simon, let's go to you next. And after I ask the question, I'm going to walk around the back of my computer and see if I can plug the webcam back in. So just give me 1 second after I do that, Simon. But Simon Klein, he's another veteran of the show. He's with TradeSmartForex.com, coming to us from across the pond. So for those of us who don't know you, Simon, tell us a little bit about yourself and a little bit about TradeSmartForex.com.
Okay, thanks, David. It's great to be here with you again, and thanks the other David for hosting this show. You can probably see my screen at the moment. It says a little bit about me. I basically have a computer science degree. That's what I studied in university. Straight out of university, I started working for Credit Suisse in both London and New York. I started on the computer side of things and then moved over to the trading floor. And then I kind of moved over into kind of full-time trading. And TradeSmart is basically a trading education and business that focuses on teaching you how to read the market professionally as a first step and how to actually run a successful trading business, including how to develop your own trading plan and strategies, which very importantly have to fit your personality and lifestyle. So it's not a one size fits all. It's kind of tailor-made to suit you within a framework. So we teach the framework in which you need to operate in order to be safe during your development as a trader, and take you through it step by step. And we have a very kind of pure approach. We're pure chart readers, no indicators, pretty much.
Yeah, and I like you and I are on the same wavelength when it comes to trading psychology, and sometimes, or all the time, that seems to be more important than your aptitude. So,
yeah,
okay,
definitely.
Serge, first time guest. We're going to take it pretty easy on you. Don't worry about that. One of the big controversies of this show is that there is no controversy. So, but if some comes up, we'll deal with it. But Serge Berger from the steadytrader.com. Tell us a little bit about yourself and a little bit about the steadytrader.com.
Hey, Dave. Hey, guys. Nice to be on. Nice to meet you, or at least virtually. Yeah, so my background is a little bit similar to what Simon has. Institutional. I cut most of my teeth over at JP Morgan, institutional side, and the fixed income side, and credit default swaps and all that stuff. And then at some point, just before the market crashed, I decided to, this sales side stuff is kind of, the writing's on the wall. So I moved to the buy side and kind of traded through the crash, and slowly started to put up my own blog out there, and pretty soon had a pretty good following, actually, also from the JP Morgan days, and then ultimately decided to start my own company, doing a lot of, they would call it swing trading, I guess is the way they look at it. Oops, it's just went black here. And so it's usually mostly stocks and ETF based, looking at the market a little bit more through a top-down lens, learning or using what I've learned on the sell side and the buy side ultimately. And so a lot of what I do now is you've got your sort of, I guess you call it like a newsletter, or trade alert services, a lot of drives. We actually do money management as well. So kind of like the whole thing,
Cool. Okay. For those of you who don't know me, my name, easy for me to say, is Dave Landry. My website is DaveLandry.com. I just give you a real thumbnail. I've been trading for a long, long time, and I've been providing web-based commentary from the late 90s, or maybe even a little bit before that. I was part of a bigger website, used to be a big traders website, one of the first, tradingmarkets.com. And then I moved on to DaveLandry.com. Over that period of time, I've worked with several hedge funds and thousands of individuals to help them become better traders. If you're interested in learning more, if you go to DaveLandry.com/CFN, which stands for Crowd Forecast News, put your information in. I'll give you free access to the members area, which includes a couple of courses, and then also I'll give you a $100 promo code so you can get all three of my books for free. So get to know me for free. And if it's something you like that makes sense, then stick around. I also have a trading service where I put out daily recommendations. I believe that you can only predict the short term when it comes to markets, but the real money is in longer term tradings. And also with the short term trading, the problem with that is something bad can still happen. But longer term, your risks are too high, so it creates a bit of a dilemma. So the way I solve for that is through a hybrid approach. I'm slotted as a swing trader, but I will stick with positions as long as they move in my favor. So I'll just show you the website where that link is, and then I'll go ahead and ask the next question. Neil, you're up next. And the question is, as it is every week, which direction do you think the S&P index will move from now until, well, I guess until from today's open until Friday's close? And then go ahead and rate your confidence in your answer to that question by estimating the probability you have correctly predicted this week's market's move. Did we lose Neil? Okay.
Hey Neil, you're muted. Okay, let's go on to.
Oh, sorry about that. Yeah, I'm going to say higher, about 70% higher. Do you want the charts now, or do you want the charts after?
We'll do the charts in the next segment. And Serge, I'm going to go ahead and ask you the same question. And if you want to share charts in the next segment for developing events, you can share your charts then. So just Neil is up with 70%. Serge, same question.
I think moderately lower, probably about 65% chance. I mean, it's largely going to be based on some large, tech earnings, the Googles and Amazons. So that's kind of a binary bet at this point. But I'm going to say a little bit lower.
Gotcha. Okay, Simon, same question to you.
I'm kind of a bit neutral on the market at the moment, and I'll go into that in the next answer. But I'd say probably 50% higher, depending on what happens today, tomorrow.
Okay. I'm going to go ahead and say lower, and I'll give myself a confidence of 65%. And then in the next segment, I'll explain that in a lot more detail. So, Neil, let's go back to you. I don't know if you got some charts ready to go or not, but if not, while I find the question, why don't you go ahead and get everything loaded up. For your answer, please share what specific reasons you think the S&P will be headed. In your case, I think it was higher.
Sure. Here's the S&P. Well, it's kind of like that. If anyone's here has seen the movie Anchorman, where he says, what does he say? 80% of the time it works, or 60% of the time it works every time. And he says a lot of sense. So I'm sort of looking at, I think it's going to be 70% higher, but don't use 10% or more portfolio. Does that make sense? I've never had to put a sort of caveat in there before like that. But basically, if I'm looking here at the S&P 500, I think I read this in a Dow theory book, and I've seen it over and over again in Forex trading and in lots of other charts when you have these big sell-offs. So first you have the big sell-off that comes down. That's obviously the bottom. That's step one. Then you have the breakout here, this green candle, that's step two. And then step three is the test of the bottom, but it cannot be the exact bottom. It must be a higher bottom. And that's what we have here. So we have step one, step two, and step three. So maybe we go a tiny little bit lower today or tomorrow, but if it goes down here where the real bottom was, then I don't expect any rebounds at all. So if we can hold where we are right now, then that's what I expect. I expect we're going to get a rally back up, and my target would be about 2880, right where this breakdown was, where floors become ceilings and ceilings become floors.
Gotcha. I don't use clouds in my trading. I do use moving averages though, but I noticed that looks like just like a moving average, the cloud will help to keep you on the right side of the market as long as it's trending. So the fact that we're below the cloud, is that a problem now, you think, or?
Well, yeah, it is a problem, but a lot of the times when it goes below the cloud, I mean, obviously in such a dramatic sell-off, we actually got out here before the break of the cloud.
Yeah.
But on a daily cloud, what you're looking for is you're not going to sell everything like crazy once it breaks the cloud. You'll have time to get out beforehand, like the bullish percent indicator. I can show it later that I often use turned lower, which is my number one indicator. I'm pointing figure up here. But on the cloud here, I'm just looking for a rebound back here. But if I go to the weekly, and if there was only one indicator, let's say someone with a 401k or IRA had to use, I would just use the weekly cloud, because I can go back here. And if we go back to the big crash back in 2008, 2009, oh, it's not showing up. But anyway, you can see how well the weekly cloud will trend, except for some of these bits here. But we're still above the weekly cloud.
Yeah, I agree with you on the longer term, and I'm going to queue up a couple things for that too. While that's happening, Serge, let's go to you. You want to share some charts with us? If not, or if you have anything you want to talk about. So,
Sure.
what specific reasons you think S&P will be headed in the direction you choose, which was lower?
I'll just share my screen. Yeah, hit that button there. Yeah. You guys see it now?
Yeah.
You can see the screen?
Yeah.
Yeah. Okay, cool. So I like to look at the market through sort of its constituents. So this is something we use here for our clients. It's called the market rover. And so I break the market down into its different sectors and groups. And what you can see here is that everything is short-term bearish except for staples and utilities, which is kind of what you'd expect in this environment. Moreover, we're not getting any real buy signals. If we click on our, we have several different indicators, two specifically to look for buy and sell signals. Most of them are still sell signals. So we're getting close to I think, quite oversold, but we haven't seen any real washout. So what we need to see is some of these sectors start to turn from short-term bearish to short-term neutral and potentially bullish. And at the same time, also some bullish reversals, which are going to have to happen at the same time with this. So to give you one simple example, when you look at, if you look at real bottoms that last for long enough, a cup of coffee, I think it's something like this food here, right? That we guess what this show is mostly about. You need to see some sort of washout that's followed by some sort of confirmation buying. And we just haven't seen it yet on the weekly chart. We haven't really seen it on the daily chart either. If you look at some of the important parts of the market, transport, banks, even large cap tech, not exactly acting very sexy. So, and I guess the chart of the week for me would probably be something like, actually not something like exactly the NASDAQ 100, which I think is just not anywhere near a point where it's giving us any reversals yet. Although, like I said before, this week we have 2.7 trillion in market cap in just a few big names in earnings: Microsoft, Amazon, Google, and Intel. That's 2.7 trillion in market cap for large earnings. That's going to matter. That's going to matter a lot. And I think if they do act well, and we see a bullish reversal, we'll probably see tech start to turn from short-term bearish to short-term neutral, maybe bullish. We'll see all sorts of buy signals happening here in tech land, which we're just not seeing yet.
Okay, cool stuff. Okay, as far as the Simon, let's go to you. I'm sorry, Simon. Simon, what developing events or any charts you want to show us?
And we'll just look at. You can see the screen again.
Yes.
Yeah. So I basically I'm looking at the E-minis here, and if we look on the monthly chart, we're still in an uptrend. We're still in an uptrend. We've pulled back down to my kind of demand zone and bounced a little bit off that. And we've done that before here and bounced back immediately in that month. We'll have to see how this month kind of closes as well. And we've got about another week and a bit left, I guess.
Okay.
Again, if we look at the weekly chart, we broke the weekly uptrend the way I defined the trend. It was broken when we went below this area, we went below these. That breaks the trend, and we kind of dropped down and bounced, and now we're coming back down. Now we have to see if we're going to hold these lows. So again, if we look on the daily chart, we can see the same thing. We can see this kind of move up, this surge up, this pull back. And one thing that we can see here is actually interesting. It's tried to go up and got knocked down again. And if you look very carefully here, there's a pivot here, and we've gone below that. So we've already gone below here, which we haven't held. We haven't held this level. Yeah, it doesn't mean that we might not hold this level. Plus, we actually based here for a number of days before we shot up, which is kind of a sign of weakness of that demand zone. So it could be, if we're not able to hold this, that we're going to just continue going lower.
Cool.
So again, these are the things that I'm looking at. Seeing a failure to follow through to the upside, even though I'm saying maybe this week 50% chance that we may go up, but again, it's looking a bit like stand on the sidelines and let's see how it plays out. And if it's able to kind of pivot here over the next day or so, then I may be interested in the long side, and we'll have to see if it takes out here. Then it's probably going to go back up to probably the 2,800 area.
Cool. Yeah, once again, not a whole lot of controversy. I agree with pretty much everything you said. Just real quick, I pulled up some slides. I did a presentation last week, which is actually live on my website if you're interested. And I like to keep it real simple. One thing I watch is what I call Dave light, meaning that, or it used to be called daylight. The lows are greater than the moving average. And this is just an example of a market that turned into a bear market. And one thing that I looked at and determined is just, number one, I like to keep things simple. But in doing that, it's like, okay, what would happen is as long as the market is within about 10% of its old highs, meaning let's say 1 year highs or so, stay long. But if it drops below or goes above 10% away from its highs and it closes below the 50-week moving average, then get out of the way. And so far, this has kept you out of every bear market in history and has kept you fairly unscathed. And I actually can give you all of these indicators if you have Metastock. And if you look at this longer term, and if you're looking at just when you have the lows greater than the 50-week moving average, like we had it here for a long, long time, as you can see, it'll help to keep you on the right side of the market. So I wouldn't rush out and sell the farm just yet, but we are somewhat neutral in this, and we're just slightly bullish in the longer term. As Simon was discussing, and Neil also, we did bounce a little bit in here, and that's got us back into the plus column longer term. Shorter term, though, I do think we have some issues, and let me just show you two things real quick. If you take a look at the S&P 500, I'm not a huge, you're seeing all these indicators, but the reality is 9 out of 10 times I just look at a blank chart, and I always look at a blank chart first. But one thing I do pay attention to is what I call my bow tie moving averages. And when you get a bow tie, meaning that the 3 moving averages come together and begin to spread out, after a market makes an all-time high, it usually pays to pay attention to that signal. We recently had that in the S&P 500. We triggered a few days ago on that. On a weekly basis, we haven't seen a signal in a long, long time. We did have one back in 2015, and it didn't turn into a bear market, but it was a pretty serious spill. And in the Russell 2000, it was about an 18% drop from that weekly signal. So if you were holding on to something longer term, I would definitely keep an eye on these moving averages. If they begin to cross over, I would become concerned. If you back the chart way, way out, you could see that we had a buy in 2009, we had a sell in 2008, late 2007, a sell in 2000, and a buy in 2003. So as you can see, it does a pretty good job of keeping you on the right side of the market longer term. So those weekly signals, very important. Let me just show you one more thing real quick, though. This is what has me really concerned. If you take a look at a daily Russell 2000, we had a daily signal right around 161 or so in here from this. I'm sorry, it's actually higher up. It's actually right here was your sell signal, about 164 from this bow tie off of all-time highs. At all-time highs, everybody's happy, but when that market begins to drop below it, anyone who bought somewhere around those highs, let's say from this level higher, is no longer happy, and that pressure is being put on those people to potentially exit the market. So a little concerned over the short to intermediate term. Longer term, I think we're still okay, but I would keep this market possibly, I'd keep it on a short leash. Just make sure you have stops in place. I think I said earlier, I've gotten stopped out of every one of my positions on the long side except for one, and I've actually started putting some shorts on. So now's the time to be very cautious. If you're longer term, much, much longer term oriented, then sit tight and hold on best you can. But if we do start seeing some of these weekly signals, now would be a good time to get out of the market. And if you go to my website, the current weekend charts that I have up, I spent about an hour going through all these indicators. And then I also have some articles that were printed on my website and in other publications I can get you links to on that. Okay, sorry for the long-winded answer. I just think now's the time where we need to really pay attention to what's going on. Neil, let's go back to you next. And the question is, if I can find it, talk amongst yourselves. Oh, here we go. Right in front of me. What procedures do you use to monitor and evaluate your trading results and progress over time? Neil might be muted again.
Typically, I just look on a monthly basis how I'm doing every month. One of my main philosophies, and Jim Rogers says this, a lot of traders say this, I think it's even in the book Market Wizards, is that some of the best trades you'll ever make are the trades that you don't make. So, I mean, I think about that sometimes. If I don't trade, sometimes I'll tell my members we're not going to trade anything this week, and sometimes we won't trade for up to 3 weeks in a row. And next thing you know, we have 100% winner on a call or a put option on something I've been waiting for. So, I mean, really, there's a ratio called the Sharpe ratio. And from what I recall, I mean, I'm not going to say what my Sharpe ratio is, but basically, as your account is growing, what is the volatility within that growth? So if you want a chart going from the bottom left to the upper right, is it going all over the place while it's going up, like some small cap biotech stock, or does it go up nicely as smooth as possible? And so that's not something that I'm calculating. Maybe I should calculate my Sharpe ratio, but I think that, I calculate what are my drawdowns, what are my biggest drawdowns per month. And the biggest we've ever had ever since I've run my service is 9% on the account ever from any given high. And that was during the crash of 2008, where I say to myself, you got to stick to your stops. Don't get out before the stops. And, we stuck to our stops. And then in December of that year, we got almost everything back. And then we shorted like crazy in March, and our accounts were at record highs in 2009. So really, I'll just look on a monthly basis and just say, I'm not going to have any big drawdowns, ever on the account. And I think in the last 2 months, our account is up 10%.
Cool. And, sticking to that system is tough, and it could have easily went right back up after that little bit of a drawdown. But yeah, it sounds like you ended up fairly unscathed from that. And that's the hard part for many, is trading a system when things are less than ideal. And you might want to just pull the plug on everything. And that's usually when you do that, that's right before a big trend takes off. Serge,
just stick to the stops. Because if you're thinking about getting out right before the stop, there's many other people are going to do it. And a lot of these market makers, man, they're stop hunters. The algorithms are stop hunters. Everyone's a stop hunter. So you got to put that stop right below where the algos are putting it, where they're going to try to chase that stop and take you out. Market makers are dropping bids. They're putting in probably billions of dollars in fake bids to try to pull the market down. And then right at the last second, they'll wait a second. Let me explain it the other way. They'll put in a bid to try to bring the market down, and then they'll pull the bid at the last second, and then they'll buy, and that's how they'll take out your stop.
Gotcha.
Yeah,
and it happens. I see it happen all the time, and that's the hard part for me in running a trading service. Is I'll say, okay, guys, let's get in here, let's put a stop here. And the stock will go sideways for a couple of weeks or whatever, or maybe even lower, but everything is still intact within the system, within the methodology. And then, of course, stock will take off, but by then everybody's gotten bored or panicked, and then they're out. And that's the hard part. Serge, let's go to you. Same question. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, I agree with you guys. I think it's an interesting conversation. It's actually probably one of the most important conversations. I always say that, a good trader knows how to take a profit, but a great trader knows how to take a loss. And, I think it's just a different way of saying what Neil just said. And it's just really important. So to me, I think a monthly to quarterly lens is kind of the way to measure your results. I think the day-over-day is really hard. I've worked around the globe at investment banks and everything, and running money and everything, and I have yet to find someone that's really successful on a day-over-day basis. I think you got to measure that. So what we do for clients, and what I preach is I believe in a multi-bucket system. So we have the primary concern for most people, and I bet you this, for most of all you clients, Dave, all you guys, the primary thing they want is some sort of income. All right, so that's one bucket. And you get another bucket, which might be your intermediate term stuff to maybe a little bit longer term, and you've got the 401k, right? So you get a capital appreciation bucket, kind of then like a playing bucket, and then a serious income bucket. And so I have to measure these things. So I'm a big option seller. We sell a lot of option spreads in a very specific way. Amazing results on that kind of super conservative strategy. Trying to go from 1% to 2% on a trade per month on a crazy conservative basis. But that's one bucket, right? You can't commingle this with the other bucket, because if you start confusing that longer term stuff with your immediate term or near term income bucket, you're done. I think that's one of the most difficult things. And I would assume you're nodding your head, you probably agree with that, right?
Yeah, that's where I'm a little torn. It's like I feel like I've got this longer term system that does really, really well keeping the right side of the market, and it hasn't triggered a sell signal yet. But the shorter term stuff is flashing all over the place. And so it's kind of interesting that you got these two things that are working against each other. But it's going to turn on the short term before it turns on the longer term.
Well, that's exactly it. That's why I built this market, which, by the way, we're going to give people access to the market overnight in here. It's like, I think you get to, I think Dave, you can put that in the other, Dave, get tstrover.com. You guys get the we call it market overnight, where you can see that. You can see exactly when something turns, from short-term bullish to bearish, and then same thing in the medium term and long term. Because again, it's all about, I think multi-time frame analysis is one of the most important things to teach people. It's just so unbelievably important to keep that long-term bucket or long-term view different from the medium and short-term, because it's like you're saying, everything changes in the short-term first, but it doesn't mean that the long-term's broken, right? It's just a short-term signal. So
yeah, absolutely. All right, Simon, let's go to you. What procedures do you use to monitor and evaluate your trading results and progress over time?
Yeah, well, the first thing you have to do is log your trades, and you need statistics on your trade. You want to know things like what your batting average is and what your average win to average loss is. And again, once you've got those figures, you can actually see if you're improving or not, or you can see what you need to do in order to improve. You also want to log things like mistakes that you make and see how many times you make certain mistakes, especially as a developing trader. I mean, once you go through the development, you're obviously making less mistakes. But as a developing trader, for everyone listening, I would imagine you're probably developing traders, then you should keep a track on how many times you make a mistake. Rather than looking at your profit or loss over a month, at the beginning, when you're starting out, you're not going to be making money. Very unlikely. So what you need to do to measure your progress is how well did you keep to your trading plan and what mistakes are you making and what do you need to do to move forward. Another thing you can do once you get a bit more advanced is to actually log in your trading log what you actually got of the trade, for example, and then go and see what happened after you got out of the trade. Did the trade carry on going? What percentage of the overall move did you actually get? And then you can actually track, and it's very interesting. If you do this in depth, you can actually start to track from your trading log what's happening in the market. Because if you start, say for example, you're in a sideways market and you're getting like 80% of the moves, and then all of a sudden you start getting 30% of the move and you're doing the same thing. Maybe the market's moved into a trending market and you want to be holding things longer. And again, this may be very interesting for you, David. Dave.
Yeah. The problem with my stuff is it depends heavily upon the outlier. And I think the statistics, I think it was Bart Simpson said statistics are worthless. 75% of all people know that. And that's the problem that you're going to run into really quick if you're trying to gauge the statistics when looking at the wins and losses, et cetera. I would much rather have an abysmal win rate and make a lot of money than an amazing win rate and lose money. The one thing that I think, and I think you alluded to this a little bit, Simon, when it comes to tracking things, I mean, obviously you got your brokerage window up and you could see the ups and downs there. That could kind of mess with your head a little bit. Like a couple days ago, I was screaming an F-bomb because one of my stocks was getting hit, but I didn't realize that another stock was actually doing quite well. Not that it always does that, but another stock was doing quite well. And I was actually making money on the day, and that other stock that was going down hadn't gotten stopped out yet. So all my emotions had nothing to do with following the system. And basically, what's the old adage? Be as close to the market as you need to be, but no closer. The way I track things is, and I think the secret, I always say there's no secret to trading, and then I tell you a secret to trading. But I think one of the secrets to trading is following the process. And I think you alluded to this a little bit, Simon. And if you're getting in where you say you're going to get in, and you're going to allow your stop to get hit where you say your stop is, and in my case, I take partial profits and I trail that stop higher to stick around for a longer term trade. As long as you're following the process, you are on your way to becoming successful, or you will be successful. Now, what you need to do after you follow the process, and like I tell everyone, just follow the plan for one trade. If you could do it on one trade, then rinse and repeat on the next 10,000 trades. My work is done. I would drop the mic, but I don't want to break another one. But if you could follow the process, that's the secret. Just do it once. And then after you do that, circle back and do a post-mortem. And I don't do this as much as I used to, but I found that years ago when I would do a post-mortem, I would say, what the hell was I thinking? And the hardest thing for us as traders, and this was in Market Wizards, I believe, is to distinguish between intuition and intuition. So it's like, do you really have the mother of all setups? And when you're looking at this trade after hours, you look at the charts, you look at where you got in, where you got out. And if you look at it and say to yourself, what the hell was I thinking? Then I think you're getting close to becoming a successful trader. And I could go on and on this, but basically what I'm kind of hinting at is a deliberate practice in following the process and making sure that you're getting better. So I think tracking your following the process is as important or more important than the statistics. Easy for me to say, because longer term, following the process in a case like my methodology, where we're looking for that big outlier, that big 100%, 200%, 300% move, if you follow the process and just keep chipping away at it, eventually that's going to come. Okay. Simon, did I cut you off? Did I started answering my question? Were you finished on what you were saying on tracking progress?
I 100% agree with you on the process. We have like half of the training that we give beginning traders. Half of it's on the market, and the others half of it is on how to run a trading business, which is that framework and process that you need to go through. I used to give a webinar, The Fastest Way to Consistent Trading Profits, which is all about following that process. And I kind of changed the name recently to The Only Way to Consistent Trading Profits, because I don't see there's any other way to do it apart from tracking everything, tracking what you're thinking and what you're feeling as you make actions in the market, so you can understand later on what was going through your mind or your emotions, what triggered those maybe correct or incorrect actions, and where's that coming from, and going to figure that out. And over time, you know, the ability to follow your trading plan is going to be what's going to get you there. Having a trading plan and not following it is the same as not having a trading plan, and that's a lack of discipline.
Yeah, so a bad plan followed well is better than a good plan not followed. You know.
Yeah.
So.
Well, the problem is, if you've got a trading plan and you can't follow it, then changing your trading plan is not going to help you, because you're not following it anyway. So you have got nothing to anchor yourself on. So once you've got that discipline, you can follow a plan. Even if it doesn't work for you, you can change the plan and find something eventually that will work for you.
Yeah, work to get better at it. I've often thought, because, and maybe you and I could put our heads together on this, but I've often thought, even though I'm a big stock guy and I do trade a little Forex here and there, but I just thought because of liquidity, it would almost be cool if you were teaching a newbie, just say, okay, open up a little micro account or mini account, whatever you call it, and I want you to follow this simple little system, good, bad, or indifferent, just to prove that you could do that, and then venture out into the discretionary trading in stocks and so on and so forth. But I think that would probably be very helpful for someone just to get the reps in. You have to be able to rinse and repeat and go through the process. And one thing, just as a side note, two things. One, you kind of hinted at an emotional journal. I think that's important too. I think it was L.R. Thomas that once said, don't expect trading to fill a hole in your life that's missing. And as I often say, it sounds a little strange, but that hole tends to move over time. And it could be a minor thing like a little fight with your wife. A few weeks back, I had a tip from my wife, and I found myself wanting to lock in a 2-point gain on something where I was really hoping to sit in that position for months and weeks and all. But here I am, because I made 2 points overnight. I wanted to lock it in to show how smart I was, you know. And so you got to be really careful with that. And another thing I think you kind of hinted at was an emotional journal. I think that would be really good for new traders, or really any traders. I should probably do that myself. Just keep a little notebook and write down how you're feeling and what's going on in your life. And you've got to be careful to not let all those things creep into your trading, because they will. And it doesn't matter what level you're at. You know, my advantage I have, and you guys have the same advantages, you see a lot of people making a lot of mistakes. So the reason I didn't cash in when I was up $2 was because I'm like, wait a minute, you're doing the exact thing that I tell everybody else not to do. So that, I think we do have a little bit of an unfair advantage when it comes to that. We see a lot of mistakes being made, and it constantly reminds us not to do that. Just because we decide to trade doesn't mean we still don't have a pulse and still don't have those same human emotions. Okay. Neil, let's go back to you. Any closing thoughts? Anything else you want to tell us about yourself, the market? Are you in the States today?
You haven't done trade.
Yeah, I'm back in North America, man.
Cool.
First thing I did was I went to my favorite bagel place, and then I got a huge sandwich later at a sandwich shop, and I was sure happy because it's hard to get sandwiches in Europe sometimes. I don't know what it is. They don't give you a lot of meat in those sandwiches.
Oh yeah. Different.
And if you ask for extra meat, they give you a funny look. So.
One second. David, did I overlook something? I'm sorry.
Oh, yeah, you guys didn't do the individual trade ideas, right?
Oh, no, we didn't do that. So, yeah, I forgot about that. My apologies. I was, I don't know if Dave mentioned or not, I was on Italian television right before this, and it was kind of like a blur. Do you guys have any, just start thinking about them. If you don't, you have a trade of the week, something you want to throw out that we might be able to use? And if not, maybe it's some sort of trading tip or trick that you could throw out. And that could be trading psychology. It could be a little indicator method, whatever you want to do. So Neil, let's do that first, and then we'll circle back to everybody for closing thoughts. Thank you, David. Sorry about that.
Sure. I've got U.S. dollar up here. This is the dollar index. I think that I watch the dollar index every single day, and I watch the bond prices every single day. So I guess I'll give two picks today. I'm not saying necessarily buy this right now because of it's close to these near-term highs, but I'm going to try to convince Dave to start trading this, because look at how beautiful this chart is. You look back here, 26th. Look at this beautiful breakout that it made here.
Hey, we're not seeing the chart, Neil.
Oh, really?
Hit
Okay, hold
share
on.
again. Yeah.
I thought it was actually screen sharing, but I guess it wasn't. Not. Okay.
No, you got me all excited. I can't see what it is.
Is it showing up now?
I think you're sharing the. You're not sharing. Yeah, there you go. You were sharing the show and not the screen.
Okay. So here's the dollar index on the 60-minute chart. You look back here, October 26th. Look at this beautiful breakout here. Breaks out, holds the cloud, breaks the cloud. I mean, goes to the resistance here on the cloud, fails. Look at this beautiful breakout again. Bounces from the bottom of the cloud. I mean, the dollar index is something, I don't know where I read this. Everyone's read the book Market Wizards, but it was somewhere that one of these big trading guys said the best trends in the world are commodities. And you can kind of look at dollars like commodities too. I mean, you're not eating it like wheat or anything, but currencies, grains, these types of things trend the best. And the greatest thing about the dollar is when stocks really start selling off, you can almost always anticipate a dollar rally, because people have to change that stock into something, right? And that's going to be US dollars. It only works when there's a big sell-off. And so at first, when stocks started selling off, it didn't happen. And that was kind of happening here on the dollar. And then I thought it has to happen. And here was that breakout, 95.20 up to 96. And what could you get on a 10, 20 times leverage trade if you time this perfectly? I mean, your account's up 10%, while everybody's wondering if they should hold their stocks, and you're getting calls from your neighbors and things like that. US dollar is something you definitely have to look at. I'm going to go to the bonds here as well. Bonds are super boring, but a lot of people don't know that in 2014, the TLT rallied 35% while you're just hanging out in long-term government bonds. And so as far as I'm concerned, the break here at 116 was the end of the 35-year bond bull market. And we bought some puts here right in the middle of the day, which was sort of rare for us, made 90% in 3 days. But I'm still looking at bonds here to see what's going to happen, because obviously interest rates go up, bond prices go down. But also people flee to bonds when stocks crash. And when stocks crash, you're going to think, well, maybe the central bank won't be raising rates as stocks are crashing. So we have to look here at TLT. If it rallies back up to around the 116 level, I think that's going to be a great short that you could maybe hold for a few years using stock symbol TMV. So that's a good one to write down, because this is the triple leveraged bond ETF. But I want to go back just a second here on TLT. Back in the 80s, when interest rates were, I think, as high as the absolute peak was 18%, I believe. And I'm going to go back here on TLT as far back as I can go. And you can clearly see that this was a bull market in bonds. And look at this breakdown here at about the 116 level. There's no way we're going to rally. So over the next many, many years, I would expect this to go down to maybe around 100 with some volatility along the way. But you can do really well, trading options on bonds, and there's not a lot of time premium either.
Okay, how far out are you looking on those options?
I only go out about 2 months.
2 months? Okay.
I mean, why should I pay the extra premium if I'm not really sure? It's not a massive macro call. I think it's going to go down right now. I want to get paid right now. Why should I, buy some June calls of next year that are going to go up 10% if I can get 100%?
Gotcha.
I'm not going to go out 1 week necessarily, but what I've noticed over time is, I mean, it's like you said, Dave, you can predict the short term, not the long term. So why would I buy long term?
No, I hear you. No, options, a lot of moving parts and options, and it gets complicated really fast. So I was just curious how far out you're looking just for the decay and everything else. And I know there's a non-linear decay and all that other stuff that you have to deal with. So I was just curious.
And I always say, don't put a lot in each trade. 1 to 2% of your whole portfolio in options. But if you're snagging a whole bunch of 50%, 100% gains in a year, I mean, your entire portfolio is up 8 to 10 to 12% in just 1 year by doing around 30 of these trades per year. And sometimes you'll lose it all, but that's just 1% of your portfolio, like you would normally lose on a stock trade. And so if you're really, really sure about something, put in a tiny bit and just go for it. But you know what? Unless it's super sensitive to news, the more of a position you put in something, the more you got to stay at the computer, obviously. So, like I said, with that US dollar trade, if you're putting some fairly high leverage on that, you got to, if you're going to put a lot in a trade, you have to time the entry absolutely perfectly. Like here, we got in right in the middle of the day. I said, that's it, it's over. But here, I wouldn't even have gotten in the next day. So if it's absolutely perfect is when you can do it. So that's really why you got to watch. You got to watch the markets every single day. Every single day, I look at all the currencies, the S&P 500, of course. I look at the bonds and I look at the dollar index every single day. And after a while, you're really definitely going to get used to the way it moves in relation to markets and everything else.
Gotcha. All right, Serge, you have a trade of the week for us or a trading idea?
Yeah, sure. Let me just flip over to my charts here so you can see this thing. I'm going to stick with what I mentioned earlier, which I really think is kind of where I want to focus things on here, and that's the Russell 2000. Man, I've said before, and again, we're going to give people access to the market rover light, which will tell you when all these stocks go bullish, bearish, and buy and sell signals happen in real time. But I still think the Russell 2000's got issues. Now, could it bounce this week if some of these massive tech stocks rally? Yeah, of course, anything's possible. But I do think here, if you to talk technicals for just a minute, I mean, we mentioned it before. This is a technical show. I mean, for one, we've broken the uptrend here. This is a simple one since 2016 lows here. But also for the first time, we're seeing the 200-day moving average flatten out while the 50 breaks below the 100-day. This is, in my eyes, a little bit too simple of an analysis, but I think it does, bring across the point fairly well. So I think one could you can either short the IWM, buy an inverse ETF. There's plenty of them out there. You can buy put spreads. I wouldn't buy puts outright, and volatility is quite expensive right now. Unlike Neil, I think at this point that's one thing I'm not agreeing on. But that's what makes the market right. I wouldn't be buying anything with less than 2 months left, mostly because if it goes against you right away, you're going to get destroyed. But give it some breathing room. This is not something that has to work tomorrow. I think give us another week or two, and if we give any strong major bullish reversals, you get back out. But I think this is a quite sensitive part of the market, and you get a little bit of leverage over the SPUs here in this one. And again, keep in mind, it's at least according to our analysis and our hedge fund and family office and those kind of clients I deal with on a daily basis. There's plenty of fear there. Although I will say, ultimately, I think there's going to be a strong rally into year end from the fund manager service that we do, and there's a lot of performance anxiety out there, to say the least.
Yeah,
I just wanted to say something real quick about the options. Is that if they're too expensive, I'm just simply not going to buy them. And so when the volatility was going up recently, I wasn't buying any kind of stock options at all, but the TLT options is very little time premium, and the dollar index, literally almost no time premium at all. And so that's why I really like to trade those.
Is it UUP you're using as a proxy on the dollar index? You're using options on those?
Yeah, UUP. And if you look at it, you'll look 2-3 months out and you think, my God, I'm almost paying nothing for the time premium on these, and that's why I like.
Cool. One thing I like to throw out, or feel like I should throw out, my only problem with those inverse funds, especially if they're leveraged, is that what happens is when the market does sell off, they're forced to short at lower levels, and the short covering rallies absolutely cream them longer term. And so if you pull up any of those short ETFs, they probably reverse split them, is why they have such ridiculously high levels. But let me just pull one up real quick. Let me just see. If we take a look at like I think TWM is the inverse Russell, and that's not leverage at all. If you go to like a longer term chart, it was at 1,300, and now it's at 16. So obviously a 1,400. So obviously it's not going to go back to 1,400. All these things tend to go to zero over time. I think if maybe in my next life, I'm going to start a hedge fund that just shorts the short things. I don't know if you could do that. Maybe you guys know if you could do that or not, but I think that if you're going to get into something like the TWM or any of those inverse funds, just have a shorter term time horizon, because longer term, the odds are going to be stacked against you if you're trying to hold on for that longer term bear market. You might be right on the bear market, but you're going to be wrong due to whether you want to call it decay or tracking, whatever. But it's basically because they have to reshort at lower and lower levels, and it just kind of makes them all go to zero over time.
Oh, I fully agree. And I think, that's, look at all those levered things. These are trading vehicles, right? It's always what I tell our clients. And you can look at things like, UNG, natural gas ETF. That thing's a beauty over time. And, these futures-based ones, they have something called, they have to roll the futures out as they roll off the curve, and that's no fun. Buying expensive futures every time you buy, that's a sure way to lose money over time. So yeah, they're trading vehicles. I fully agree.
Yeah, the world's that gets the point is, anytime you're dealing with derivatives and all, the world's a lot more complex place than it might seem on the surface. And a lot of people even go on TV and talk about these VIX funds, and they just got it absolutely all wrong. And that's part of the problem, like you said, is because some of these VIX things are actually based on futures. Okay, Simon, before I forget, let's go over to you. You have a trade of the week for us?
I just wanted to follow on from what Neil said. I also follow the dollar index every day, and I put out a video once a week on it, and it's pretty accurate, and you'll, I guess, learn how I approach the market. It's pretty accurate. And let me just show you. You can actually, if you go to my website, TradeSmartForex.com, you can actually click on here and you'll go to my YouTube channel. You can subscribe to it, and you will get a notification of that every time I put one out. I usually put it on Sunday before the week, and I go over what happened last week, what I said, and watch bar by bar on the daily bar how the market played out based on what we said, and then we predict, or whatever, we give a forecast for the week to come. And again, it's all there. You can go back and look at what I said a year ago. I've been doing this for quite some time. Now, I want to tell you, one of the traders that came to me from that video, and there's a webinar here which you can actually, it's still available. You can click here and watch the recording of it. And there's one trader called Jane who actually it's very interesting. After she went through she joined the trading room, and she went through she came through a trial, and then she came again for another trial, and then she did one of my training, how to read the trend. And she managed to turn a $10,000 account into $50,000 in 6 months. And then she went on to make a further, and she's making now averaging around $350 a day. So the nice thing about this story is that she is living in Austria, and she couldn't get a mortgage because she didn't have a big enough down payment. She actually made enough money from her trading account to actually make a down payment, and she actually bought a place, which is a really nice part of the story. And she continues, she's in the trading room with us. She continues to make around $350 a day on a $50,000 account, and she draws out her profits regularly. So the training that actually turned her around was this, how to read the trend. And it's, again, you can go to this if you're interested, and anyone who takes this training You can come into the trading room for 1 month as well for free. And again, there's no recurring fees at the moment on that. It's just come in and you don't have to forget. There's nothing to cancel. You know, it's just come in and see what it is, see if it's for you. If it is, you're welcome to stay. If it's not, then that's fine as well. So I just wanted to put that out. Trading idea I'll give you, and this is the dollar index over here, is that if you find an entry on a larger time frame, for example, and you're not sure of the entry, drop down a time frame and wait for the similar entry on a lower time frame. That's what we call like a secondary entry. Sometimes it can keep you out of trouble. If you're trying to buy a pullback, for example, on an hourly chart, and you're not sure whether to take it, see if it pulls back a bit on the 5 minute. If it pulls back and doesn't give you an entry, then you're not in the trade. Whereas if you were to take it on the larger time frame, then it may just stop out. So this is the general kind of rule. The higher the probability of the setup, the least confirmation you need on the entry. And I'm going to repeat that one more time so you understand. The higher the probability of the setup, again, you have to understand how to do the market to know what the probabilities are, the least confirmation you need on an entry. That's it.
Cool. All right. Well, let's, Neil, any closing thoughts or anything else you want to tell us about TraderReview.com?
Yeah, you can go to my website. I've got some great reports that talk about the Ichimoku cloud and point and figure and how some of these signals can help you in the market. Especially my #1 signal, the bullish percent. It's 0 to 100 analysis of what percent of stocks in the S&P 500 are on buy signals, and this will always. Every time I've ever seen it, it's always turned down before any type of market crash. So I also look at that every day, and I also send out good macroeconomic advice every day.
Cool. Okay, let's go over to you, Serge. Any closing thoughts? Anything else you want to tell us about the SteadyTrader.com?
Yeah, I mean, you know, like we said, to me, it's all about understanding what happens to the market as sort of a little more from a top-down perspective, you know, as well as then kind of more links and technical analysis. And what we do is we look at the market, you know, through its constituents, because at the end of the day, it's the constituents of the market that makes up the whole. And I think a lot of people forget that. And so that's what we developed this dashboard for. This is called the Market Rover. And so we're going to give free access to the light version of it. So you go get tSTRover.com. Again, I think the other day said he's going to type it into the chat box, something like that. Get tSTRover.com. You get this version, and you're going to be able to see when stocks go bullish, bearish, in different time. So, for example, look at the Tiffany, for example. It actually went short-term bearish just 2 weeks ago. It gave us a beautiful sell signal right here. And it's not because just Tiffany went short-term bearish, because the whole consumer discretionary sector went short-term bearish, which has happened on the upper part here, where you can see what happens to the sector. So that's, you know, I think in general, just people should pay a little bit more attention to the constituents, because they look at things so as a whole and forget that at the end of the day, you know, there's a reason why things go up and down, and also don't forget, and then leave it at this: stocks are a very highly correlated asset class, right? So on any given day, the S&P is up or down 1%. You can bet that about, you know, between 60 and 80% of stocks were also up or down 1% that day. And that correlation is even higher, much higher within sectors and groups, right? So that's why we look at it this way. So once you can get the sector and group done right, you know, then you have a really good chance of getting the individual stock right. So just like the two discretionary stocks went short-term bearish 2 weeks ago, and then we, based on that, found an opportunity within that sector, found this stock that gave us a sell signal here. You know, that's it's all about putting the odds in your favor. Now I can do it that way.
Cool. Simon, you'd sort of wrap things up in the last one, but I just want to double check with you. Is there anything else you wanted to add to anything you've said today?
No, that's fine, Dave. That's it. Cool. I kind of wrapped it up with the last question.
Cool. You know, I'll do the same. As far as trade of the week, we are short this. I am personally short this, and my clients are short GoDaddy, GDDY. I'm not a huge fan of shorting, but I short for 2 reasons. When the opportunity, of course, presents itself. Number one, it's the only way to make money when the market goes down, but it's not an easy way to make money. I would much rather be in a stock and let it run up 200 or 300 or 400% than try to get in the shorts and make some money on the downside. But the reason I do short, even though they can be a real pain in the butt with these retrace rallies and all, is because it helps me to see both sides of the market. And even if I don't make a lot of money shorting, at least I know that I'm seeing both sides of the market. And you get into a market, obviously, like 2008, you can actually make a little bit of money while everybody else is kind of freaking out. Anyway, the pattern is a bow tie. It triggered recently, but now that it's bounced a little bit, I would say maybe get in below the low and then maybe have a stop way up towards the prior highs in here, because obviously as a trend follower, if it does not continue to roll over, then you are wrong. So that would be my trade of the week. Not my most exciting trade of the week, but something that you might want to take a look at. As far as my website and as far as all this, the market timing things that I've talked about, if you go to davelandry.com/CFN, and I'll make sure I add all these things in that I talked about today. But I just put a micro course together on market timing, and that'll be available for free if you would like. A lot of the things I talked about today. Also have a lot of introductory material, all free, a little mini course on my methodology and trading psychology and all these other things that are available. So just put your name in, davelandry.com/CFN, and then that stuff will come right out to you. And again, you'll get a $100 gift certificate, which you could reuse and get all 3 of my books for free. So get to know me. And then if you like what you see, then you'll love what's behind the paid section and the trading service and other things like that. Great show again. I'm not going to name everyone just so we could get things wrapped up. I'll let you do that, David. But I always learn something. I actually have a page full of notes that I took in this show. So these shows are always a lot of fun. I always learn something. So I want to thank you guys. This was I know I probably say this often, but this was definitely one of our better shows. So David, let me go over to you and let you wrap things up.
Yeah, thanks, guys. Great show for number 200 of the Crowd Forecast News show. So just a reminder to everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory. You can also go to TimingResearch.com to get access to any of the past reports or past shows there. Be sure to join us tomorrow for the 53rd episode of Analyze Your Trade. That'll be Tuesday, October 23rd, 4:30 p.m. Eastern Time. Jim Kenny, Mike Bassani, and Michael Filigera are going to be on that one. And you can always go to TimingResearch.com/live to view any of the live shows. And finally, I just want to thank all my guests again for this week. Serge Berger of TheSteadyTrader.com, thank you for being here for the first time. And also Neil Batho of TraderReview.net, Simon Klein of TradeSmartForex.com, and Dave Landry of DaveLandry.com. Thanks, everyone.
Thank you, guys.